Good afternoon, everybody. My name is Guy Silbert from Pinnacle Investment Management Group, and thank you very much for joining us for this Meet the Manager session today with Jacob Mitchell, who's the CIO of Pinnacle affiliate Antipodes Partners, and Andrew Parsons, CIO of our affiliate Resolution Capital. A very brief overview of both firms for those who might not be familiar. Antipodes is a global investment manager which applies a pragmatic value approach to investing in global stocks. It has over 10 billion in assets under management, and its flagship global fund is bronze rated by Morningstar. Resolution Capital is a highly rated specialist global REITs and real assets investment manager with around 14 billion in assets under management. And the Resolution Capital Global Property Securities Fund is gold rated by Morningstar. Throughout today's session, you'll have the ability to submit questions to either manager via the Q&A tab, and we will endeavour to leave time at the end for a quick fire Q&A. If you can be sure to include your name when submitting the question, rather than just posting the question anonymously, this will enable us to respond to you after the session if we don't have time to get around to your question during the session. Your name will only be visible to me as the moderator and not the public forum. Okay, so first off, we're going to hear from Jacob Mitchell with Antipodes' views on the state of global markets and how the team is aiming to build resilient portfolios during this challenging period. Jacob, if you can start sharing your screen and kick things off for us, please.
That's great. Thanks, Guy. Thanks for the introduction, and let's jump straight in. It's good to be here. Good afternoon to everyone. Just as some brief words of introduction, Antipodes is managing just over 10 billion. We have an investment team of just over 30, and we have offices in Sydney, London, and North America. In terms of our approach, we really see in terms of key competitive advantages. Step one, what do we mean by pragmatic value? It's ultimately, paying the right multiple relative to the underlying business resilience and the level of growth that you're gaining exposure to. We describe this as an all-weather value approach. In terms of process, we lead with industry analysis, and that leads to contrarian investment cases. And we can build high conviction portfolios as a result of that without excessive single name concentration. Portfolio construction is really evolves out of that bottom-up analysis, but we combine that with a top-down approach. And that, I think, is a great from a risk management perspective. It delivers, I think, an improved risk-adjusted returns, avoiding major sort of potholes in the macro. And we reinforce via the organizational design, robust collaboration across the process, which ultimately makes it, repeatable, and also is a key mitigant to key person risk, and we think maximizes client alignment. Just turning to our next slide. So we just want to unpack pragmatic value a little bit more. What we're showing here is some positions in the portfolio, some of our larger positions. And at the bottom there, in the bottom left, you can see Total Energies, an oil stock, a bank, ING. Now, these are GDP growers. They tend to be a little bit cyclical in the way that grow. So you can own those, but clearly you want to be buying them at a lower multiple than some of the other stocks there that are higher growth. So in the middle, SAP, Sanofi. I'm going to talk a little bit about Sanofi later. And then at the higher end of growth, TSMC and Microsoft. Once again, you need to pay an appropriate multiple, but you want to be buying or investing in those areas at a discount to their valuation. And also, we would be looking, as we describe it, as a margin of safety, but with multiple ways of winning. And that's where our contrarian insights come into play, because we acknowledge that it's difficult often to find a resilient business that's also a great investment, and it typically happens because the market's getting sort of concerned about something, and we need to, as in the research process, work out whether the market's right or wrong. So look, setting the scene for let's call it that top-down discussion about where we're at in the cycle. What we're showing here on the slide is what we think is a shift to a new regime of fiscal activism that really started in around 2018 with the Trump tax cuts when the US was close to full employment. And since then, we've had a much more volatile policy cycle. In terms of inflation, whilst it's coming down, we do think the economic cycle, including inflation, will be much more volatile going forward for a number of reasons. But probably the key ones here is that, China's no longer a low-cost manufacturing source of low-cost manufactured goods, which was the biggest source of deflation in the last couple of decades. We think aging populations are inherently inflationary. Decarbonisation is, and look, we will get some offset from AI and machine learning, but we don't think that will be sufficient. More importantly, the policy environment is going to be much more volatile. And in those more volatile environments, similar to what we had in the 70s and 80s, the cyclically adjusted PE on the S&P, which today is 28 times, averaged around 11, let's call it 11 times. So, the journey to a lower multiple could be quite volatile. What we think is going to lead us going out of when we see weakness in the economy, we think governments will be leaning on the fiscal channel to stimulate, as they did in COVID. And we think that will come around a more focus on tangible investment over intangible, which is what we're capturing here on the slide. You can see there back in 1980, we've totally flipped around the balance between, let's call it intangible, which is investment in software and intellectual property. It's kept growing as a percentage of total investment. Let's call it business and government investment. But investing in stuff, in equipment, physical stuff, declined from 70% to roughly 50% of total investment. We think we're set to flip back the other way, as decarbonisation is inherently capital intensive. It solves for risk rather than for productivity. And I think that's an important distinction to make. Now, where are we at? Like, if you look in the chart on the left, you can see the leading indicator for Western economies, which is the yellow line. This is using the US as a proxy. Has continued to fall. And what we observe is that a lot of the tightening that Fed has put into the system, it actually takes time. There's a lag before it starts to actually impact the economy. But we think ultimately the impact on employment and consumption is inevitably coming. We think, earnings are still, if you look at the right-hand chart, earnings are still, or valuation multiples, especially in the US, are actually quite high. As I said before, the cyclically adjusted PE is about 28 times. So we don't think we're pricing in the recession that we think is coming based on how much tightening we've had in the West. In the US. Now, we've arguably in Europe and emerging markets where you had a lot more, you had an energy crisis that impacted European earnings, and China was in a recession by its standards. We think you've got, the multiples already reflect a somewhat recessionary outcome. Now, the other thing we observe in the economic backdrop is the divergence, a very big divergence between what's happening in China and emerging markets versus the Eurozone, the US and Japan. So the yellow line there is China, which is a good proxy for EM, and it's inflecting up. So we see industrial production and our forecast for industrial production based on the amount of easing that we see in the system inflecting up, whereas it's inflecting down in other parts of the world. So the question would be, once again, if emerging markets, they've always traded on a discount. So how big is the discount today? Well, the interesting thing is, against that better outlook for China and EM, China's trading on one of the biggest ever discounts to global markets. So it's, very, obviously not pricing in a lot of optimism. And we know there's geopolitical concerns, but, the macro, sometimes those concerns can be over extrapolated and really provide a great pragmatic value opportunity in markets. A quick geographical around the grounds on the portfolio and where our long portfolio positioning is. You can see in North America, we are still underweight because of we tend to see fairly persistent overvaluation in that market. But it's still the largest overall exposure, and we're underweight in domestic cyclicals, such as the financials, which have obviously, that's been a good place to be underweight. We do own software and internet, but we are underweight mega cap tech. So we're overweight energy and pharmaceuticals, and I'll talk to one of our holdings in that sector. Europe, we're overweight, but we're overweight in, double overweight the benchmark, but in multinationals. So we're actually taking just great, really resilient businesses that are less correlated to European macro, more correlated to global macro, but are really cheap, as you saw, based on the prior slide. Similarly, developing Asia and EM more generally, more exposure to companies that are not multinationals. They're more exposed to those local economies, but at interesting valuations. Looking at the portfolio, a different sort of take on the portfolio, on the long-short portfolio. You can see the top layer there in terms of foundational layers. You do have those more cyclical businesses, more GDP grower, but cheap relative to their growth. The second row, the investment trends. Look, these are really interesting. These are sometimes, thought about as being cyclicals, like Siemens Energy, but they're transitioning to a much more structural growth, and they're very cheap relative to that transition. And then in the bottom row, the third row, defensives, and they are, higher growth companies or just very high quality companies, but are cheap relative to that. And then in the long-short portfolio, we also have the ability to hedge tail risk. We run single stock shorts, and we have exposure to gold in both the long only and long short portfolios. So one stock, and a great example of one of those cheaper defensive stocks in the pharmaceutical sector, Sanofi, we like. It has a great, there's diversification in its business. It's got a very little exposure to US drug pricing risk. It's got a reasonable pipeline, no obvious exposure to very large patent cliffs in the pharmaceutical business. And it also has great diversification from vaccines and rare, rare disease businesses and consumer health. And this is all available to you on a 12 times PE, which is quite remarkable when you think at how expensive defensives are in other parts of the market, like consumer staples, where companies that are much lower growth are trading on PE multiples in excess of 20 times. Siemens Energy, one of those cyclicals that's transitioning to a much more structural level of growth. It is the global leader, one of the leaders in wind turbines and the global leader in offshore wind turbines. As we know, it also manufactures gas turbines, which is interesting. We don't think it's a sunset business. Gas is a credible transition fuel in terms of the energy transition, and it makes high voltage transmission equipment. And for decarbonisation, we will need to strengthen the grid. So you can think about it as almost the one-stop shop for the energy transition. For a company that has exposed to a step change in investment in the electrification, the replacement of fossil fuels with renewables, and the investment in the grid that we needs to take place, it's extraordinarily cheap on 5 times 2025 EV to EBITDA. In summary, whilst we have a Western recession as the base case, within that we do see parts of the market that are already priced for recession. So we're actually quite constructive. We think this regime shift to fiscal activism is going to be great in terms of driving different outcomes. It's a real shift from the digital cycle, which is maturing, to an investment cycle of or in energy transition and onshoring. We can see tail risks, and we're certainly seeking to protect our investors from the tail risks that we see on the horizon through our stock selection and through our top-down approach. And we think pragmatic value, as you can see from a performance perspective, even year to date, when we've had a market that's been dominated by the resurgence in mega cap tech, which we're underweight, we've kept up with the market, and we've generated very good outperformance versus ACWI and also versus ACWI value. The long short portfolio simply delivers a similar record, but with less volatility, and both funds have displayed, in terms of drawdown, that all-weather approach, and with much better drawdown performance than their respective benchmarks. Excellent. I'll wrap it up there. Thanks, Guy, and thanks for all our listeners for the time to present today.
Thanks, Jacob. We're now going to move straight on to the outlook for portfolio construction in the global listed real estate sector with one of Australia's most experienced investors in this space, Andrew Parsons. Welcome to Meet the Manager. If we can please get you to share your screen and begin.
Okay. Let me just see if we can get this happening. All right, I think we're good.
Yep.
Well, terrific. Well, good afternoon, everyone. Andrew Parsons from Resolution Capital. Yes, so global real estate. Just turn to the summary of Resolution Capital. Obviously, been investing in the space now for nearly 30 years overall in terms of listed real estate. Started a global strategy back in 2006. So I think it's fair to say that we've been through the ups and downs and trials and tribulations of markets in general and real estate in particular. Obviously, the headlines today continue to be somewhat concerning. And in fact, what we're seeing is a number of headlines that we think is cause for some concern, clearly, but is really, dare I say it, and I'm going to be careful about not underappreciate issues, but we think it is manageable and not excessive and not particularly systemic as far as real estate's concerned. But clearly there are some challenging areas, and the office market in particular, particularly in the US, is problematic. But as I'll explain, this is not that significant from a listed real estate perspective, and frankly, even overall for real estate in general. For starters, the REITs are actually well positioned in relation to the issues facing the banking sector. Clearly, we have a situation where US regional banks are going to be problematic for a number of different reasons, but the listed real estate space has very limited reliance on that part of the lending market. It is important, obviously lending and the banking sector is important to real estate because obviously real estate is an area that does rely to a larger part than many other parts of the economy and the market on debt. But as you can see here, the listed market is not reliant on banks in general. They have good access to the capital markets, where the overwhelming majority of listed REITs, and certainly in our portfolio, have investment grade ratings and therefore can tap into a very broad range of capital providers. Now, one of the other encouraging things is not only do they have good access to debt, but the situation is, particularly for the US REITs and also Australian REITs and many other parts of the world, is that they've actually fortuitously been deleveraging financially in the last 5-10 years. They were not enticed into excessive lending during the low/negative interest rate environment, which, when you think about it, is still hard to believe that we had that dynamic. But fortunately, as I said, the REITs weren't enticed into over leveraging during that period. In fact, they've been deleveraging, and that again puts them in a very strong position going into any period of duress, that in fact they will be able to take advantage of any distress in the broader market that if that were to eventuate. The other thing that's worth noting is that a lot of the headlines clearly relate to the office market. And you can see from this slide that office exposure within the listed real estate space is actually quite modest. It's less than 10% overall. And in terms of exposure to the US office market in particular, it's about 2.5%. So the problems in the office market are not going to overly influence the overall picture for the listed real estate market, at least. In fact, the portfolio opportunity set that we have is quite extraordinary in terms of the depth and breadth of the different types of property that we can invest in. A whole range of specialist areas, including the traditional buckets of retail, office, and industrial logistics. But what you can see here is that there's actually a very significant amount of opportunity available in healthcare, self-storage, various forms of residential, whether it's student housing, manufactured homes, which is trailer parks, housing, which is your traditional single-family homes, as well as apartments. So it's quite, again, a terrific opportunity set and sectors that are actually enjoying very good conditions currently. Now, as a guide, what we have as a situation is the listed real estate space is trading at a discount to appraisal-based valuations, and that gives us certainly a buffer of value. The gap, as you can see historically, it converges over time. Very rarely does it trade in line for very long, but that's a whole range of different for a range of different reasons. We think one of the important aspects is liquidity. The listed market does price every day and it reflects the market's most up-to-date take on economic and financial market dynamics, whereas the unlisted market tends to lag. What we have is that the listed market is, yes, to some degree, a forward indicator, but one of two things is going to happen. Either the listed prices will rise or the unlisted prices will fall, or a combination of the two, but they will converge. Now, for those people who are concerned about volatility of the listed market, well, we can solve that. We can just go and say to all the listed REITs, why don't you just suspend your shares and delist them so that you're no longer trading on the stock market? That way the volatility goes away and we can come back and report to you that valuations have gone up 10, 20% and everybody's happy. Of course, I'm being facetious because the reality is that in so doing, you then remove the ability for you to be able to liquidate your portfolio. And that's what's happening in the current direct market. There's a dearth of transactions taking place. The unlisted direct market has not yet fully factored in the changed economic and particularly monetary policy settings in terms of the move from QE to QT, higher nominal interest rates, etc. And so what, as I say, we believe the listed market is actually being, we think, more reflective of the overall dynamics. One of the other, I guess, encouraging signs, as you can see here, is that the implied yields of the listed market is factoring in a tougher economic picture. So we can see that this is the cap rate cycle and that the listed market is now trading above its long-term average in terms of yield. And so that tells us that arguably if the real estate fundamentals are reasonable, it's probably safe to go back into the water, and we'll touch upon that. But yes, it could get worse. Obviously, the GFC, for example, when cap rates did soften considerably. But we think that the supply picture and the balance sheet issues for the listed space certainly suggests that, as I say, we're now heading into an area that gives us a little bit more comfort about being confident about investing for the medium to long term. One of the other great things about the listed real estate space is that it gives investors a competitive total return, but certainly derives a reasonable amount of that total return from income, which is obviously an attractive profile for those looking for wealth creation, but certainly who would like a higher element of income. Now, as I said, the reality is if the real estate fundamentals were inappropriate, then it doesn't matter the rest of the discussion. At the end of the day, it's a supply and demand game. And if we have high vacancy rates and continued elevated supply, we're going to have a picture of no pricing power. And that's not the sort of investment that you need to have exposure to. But you can see on the chart on the left that the REITs are actually enjoying near record levels of occupancy. And this points to the quality of the listed operating platforms, that they're enjoying very strong levels of occupancy. And again, that indicates that there is some element of pricing power, that landlords are going to be able to drive rent growth at least, if not greater than the rate of underlying inflation. Now, the other aspect, of course, is supply picture. If we're facing a period of excessive supply, prolonged and excessive supply, again, that will make life very, very difficult for real estate investors. But what we can see is in this chart is that, in fact, we've seen a period of relatively low supply after the GFC that only got back to the long-term average for a couple of years. Yes, it's gone a little bit higher, excuse me, for 2021, 2022. The pleasing thing is that, again, it wasn't after a period of excessive supply that we saw, for example, between 1996 and 2006, and certainly back in the 70s and 80s. So the supply picture to us looks very supportive. And in fact, because interest rates have moved up so aggressively and conditions have changed so dramatically, we're actually seeing that supply chart turning down dramatically. And that, again, is in a period when we're looking at quite high levels of occupancy. So that gives us great encouragement for the medium to long term. The capital is being more selective, more disciplined, and that sets up the real estate space for competitive returns. Now, to give you a flavour of the sorts of investments that we're seeing out there, this stock is called Invitation Homes. It's one of our biggest stocks. It's a simple story. It owns 83,000 homes, predominantly in the Sun Belt of the US. It's enjoying extraordinary occupancy levels of 98.5%. It's enjoying very strong levels of rent growth. It's got a very strong balance sheet. And for us, it remains pretty attractive value. What we've done is we've looked at the implied value per home. So it's circa about $335,000 a home. Now, if we were to go out and try and replace this portfolio in terms of buying the land and building in comparable locations and building upon it, you're talking about a replacement cost of over $370,000 per home. And we've also checked the median house price in the markets where the properties are, and it comes out at least $400,000 a home. So you're certainly buying it at a discount to what it would take to buy individual and build and replace. And here you have the benefit of diversification, 83,000 homes, an implied yield of about 5%. I mean, think of the Australian residential implied yield, it'd be in true terms, let's be honest, it'd be sub 3%. Rents continue to grow at or above inflation, which is driving very strong earnings growth. Now, again, fortunately, what we like about these stocks is that their dividends they're not paying out 100% of their dividends. That's giving these vehicles the capital to keep reinvesting in the properties, to keep them competitive, and to take market share in effect. So again, a very strong picture. Elsewhere, driving the healthcare and aging demographic dynamic, we've got exposure to a stock called Welltower. It owns senior housing as well as some medical office buildings. Again, this is a stock with facing very strong continued growth driven by the aging population, and the fact, because of COVID, that new construction of aged care facilities effectively ground to a halt, and that's creating a very conditions for a very tight market for at least the next 2 to 3 years, if not beyond, and again underpinned by that aging demographic demand driver. So look, there's no doubt that there's a number of challenges ahead of us. As Jacob said, the outlook for the economy is looking cloudy. We think it is going to be a challenging period, continue to be a challenging period, but what we like about the listed space is that it's very well positioned. And in fact, the listed space, we feel, is in a position to take market share. in terms of operating fundamentals, and also the ability to go out and take advantage of distress or duress in terms of real estate that is going to hit the market in the next 12 months as people find it harder to refinance their property in terms of tighter credit market conditions. So very strong balance sheets. We're talking about a sector, again, that has very limited near-term finance needs. In fact, in the next 18 months, less than 15% of their debt is up for refinance. So there's very limited refinance issues. As I said, the dividend payout ratio is conservative. And we've got best-in-class operating platforms with above industry average occupancy. And what shouldn't also be underestimated is leaders in sustainability. In our travels around the world in the last couple of months, we've seen very clear signs of not only regulatory hurdles being placed upon real estate owners by requirements for more sustainability, but also by the tenants who are demanding it. So we think that the listed industry is at the forefront of sustainability initiatives. That again means that it is in a position to take advantage and grow market share and enjoy high levels of occupancy and pricing power. And of course, the other thing with the listed market is that the liquidity. I think over the last 12, 18 months, what you've seen people who haven't been able to sell their real estate, and it's been caught up in the general equities and bond sell-off, and it's been hit disproportionately hard, which means it's trading below appraisal-based valuations. So all in all, it's a sector with pretty good operating conditions, very strong balance sheets, and trading at relatively attractive prices. Thank you.
Thanks very much, Andrew. And in the interest of time, I think we will wrap things up here. A few questions did come through with regards to the impact of the US debt ceiling and how that could impact stocks. And another question came through for you, Andrew, with respect to sort of the outlook for office. So maybe what we will do is we'll respond to those questions over email. Just due to the time constraints. On behalf of Pinnacle, thank you very much, everyone, for joining us. We hope that today's session did provide you all with some valuable insights into building resilient portfolios amid market uncertainty. A big thank you to Jacob Mitchell from Antipodes and Andrew Parsons from Resolution Capital. And if you do have any further follow-up questions or would like to learn more about investing in global equities with Antipodes, or REITs and real assets with Resolution Capital, please contact distribution@pinnacleinvestment.com. Thank you very much.